Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 24th edition of Market Outlook. Well, this week marks the 50th anniversary of President Kennedy's assassination, something that I will never forget as I was in elementary school and they wheeled in the big TV with a tiny black and white screen, and Walter Cronkite comes on, takes off his glasses, and announces the president is gone. So that's a memory I'll never forget. So let's take a moment of silence. Truly a great man and an inspiration to millions of people. Well, this week the spiders, the S&P 500, moved on to make record highs along with several of the other indices. We pointed that out. Things are in gear. So let's just review where the key points are. First of all, we've got some resistance probably around the 184 to 185 level. So you're talking another good 2-3% to the top of this channel, which we had pointed out, right? We've got a nice channel here. The top is that 184, the 185 level. Obviously, if we start breaching that, we'll have to redraw and look at further extensions. Interestingly enough, not overbought nor on the relative strength index. Volume has been really light. So even though people are moving into equities and the percentage of portfolio allocation to equities has been on the rise and relatively high over the most recent number of years. I think we're at 57% in portfolio allocation, which is up about 7% from recent numbers. So even though the numbers here aren't showing massive volume, there is volume coming into the markets and the percentage of equity ownership is up. Nonetheless, we're not seeing any real signs of deterioration. Would I like to see some heavier volume come in at these levels? Yes, but somehow, I don't know, the market is just, these spiders are just not showing up at all through this move up through most of the year, with the exception of the earlier part of the year. But nonetheless, the market continues its relentless move forward. Okay, let's go back here. Let's look at some stuff on the downside. This 175 level is really crucial level here. That's where we've had several engulfing patterns, or what we call slingshot patterns. We really want that to hold. And so that 175 is certainly critical on any sell-off, even with a breach of the 10-day moving average, which comes in at 178.96. It should really act as pretty good support. You've got all this work here. Obviously, a significant penetration of that. The next line of support, and much more important, is really the low that was established on this day here, and that's around the 174.75 level. All right, let's take a look at the volatility and sentiment. As you can see, the VIX, the tradable VIX that they just did the reverse split on, and basically showing signs of some exuberance here. Now we keep on trending down. Now the thing about the sentiment indicators, especially in a bull market, it often takes a little bit of time for a potential signal, which in this case, bottom of the Bollinger Bands represents irrational exuberance. So want to keep an eye on the fact that the sentiment is really positive, not surprising, and we really now want to see a move above the 48 level before we can say that potential true correction is underway. Nonetheless, this is a warning sign, but it really has to move above that critical point from 3 days ago. All right, that's worth noting. In terms of overall breadth, the McClellan oscillator in neutral territory, indicating markets neither overbought nor oversold. We sort of got up there a little bit overbought on that indicator, the McClellan, that goes out a couple of weeks. But we sort of got sideways action, which is pretty typical in a really strong bull market. On the shorter term, advanced declines, up down volume, no read here. There's plenty more to the upside and even to the downside as well. So it's sort of in neutral territory. So that is not giving us a reading. Now, two new things we're going to introduce this week. Taking a look at the ratio between junk bonds and the 20-year Treasury. So in this case, we're looking at the weekly chart here. This is the weekly chart of junk bonds. This chart here is the weekly chart of 20-year Treasuries. And over here we have a moving average of the ratio. And you can see as the stock market over here on the left, what I've put in is a bunch of timing signals that correspond to the crosses of this ratio over the moving average. Right now you can see the TLTs and the junk bonds. Obviously junk is actually performing well relative to more conservative U.S. Treasuries, which is a positive sign. So as this ratio moves up, you can see how the market has moved up as well. So some of the short-term timing signals are here. You can see, junk JNK didn't really start trading until I think mid 2008. So we're going to take the signals most recently. You can see that we started right here. You got a nice sell-off, buy signal here, a sell-off in here. This is a pretty interesting timing model, which gives you some great S&P sell signals. You combine that with the way way it works, the S&P looks against the U.S. dollar. You got two confirming and different ways of looking at the market. One is looking, of course, at the debt. One is looking at a pure play of the value of the U.S. dollar rather to the market, which we'll get to in a second. So right now, things on a weekly basis are very much in gear. Junk is holding up well relative to bonds. That's a good sign. People aren't concerned about junk debt, people defaulting, and that's definitely a vote of confidence. So you can see, again, these signals, but most of all, it's been pretty much intact most of 2013. Now, in the financial crisis and through 2011, and even going back, you can see that this ratio was dropping sharply. So this is a pretty good indicator. Right now, we're on a firm buy. Let's take a look at the dollar versus stocks as well. Similar concept, right? As the dollar weakens, the market is very bullish for the stock market. And again, we'll go to the weekly chart. This is we're using UUP, which is the dollar bulls relative to the S&P with a moving average of the ratio. And you can see clearly through the financial crisis, this ratio got really high and it corresponded to a massive sell-off in the market. Once this ratio crossed early in the 2009, the market pretty much hasn't looked back. But again, some excellent timing signals relative to the dollar. This is indicating certainly that this ratio indicates further strength and support to the rally that is currently underway. One last thing before we head off here for the rest of our weekend. Let's take a look at Tesla. We covered that. As you know, we've been reporting on this and actively watching and trading Tesla. So here you have the overall pattern. You can see once we sort of breached this this 50-day moving average and the 10-day crossed, we did get a brief rally of a couple days just into the earnings report, and since then the market has just cratered. So we've got a good $60 to $70 move so far to the downside. These type of parabolic moves, when they're broken, have a tendency to break hard, break fast, and go a lot further than what's expected. Now that doesn't mean we can't get another nice pop here, but my guess, with the fundamental issues that the company has to resolve and the bubble being here pricked, or the parabolic move breaking, that we're going to end up ultimately seeing even more downside, which is, again, I do not want to rule out, certainly with all of this action here, a potential rally, maybe even back up to the 160 level, where the 50-day moving average comes in. On the other hand, we should possibly get a support around that 110 level, but this 110 to 115 is approximately a 50% correction of the entire move up since this thing started, which was started at about 40. So let's take a look at the daily chart. I mean the weekly. That's a daily right here. But on the weekly chart, you can see we had a move here from about 35 all the way up to 195. That's a $160 move. A 50% correction of that, it would bring you down to this 115, 120, maybe even 110. There should be some support here. Now on a weekly chart, looking at the 200 week, if all hell breaks loose, certainly and quickly, the $80 a share level should offer some decent level of support. So this level here around that 110 to 115, which coincides to the 200-day moving average, also works as a 50% correction. Okay, that's it for now. Have a great weekend, and see you next week.